Hey everyone, happy Friday. Welcome to the final bar. Today we're going to wrap the week. We'll focus on what we've learned over the last 5 trading days. It's been a lot. Had some fantastic discussions and the major averages finishing pretty strong. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to this Friday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. StockCharts is driven by tools, education, and commentary. Hopefully in this show, you get a taste of all three, but really to help promote the discipline, the insights that you can get by charting market activity, right? And I was taught that price represents all the buyers and sellers coming together. So if you have a good analysis of price, you're having a good analysis of investors and their emotional state. And we are going to talk emotions today because there's been a lot of movements and the major averages sort of resolving to the upside going into the weekend. We'll get to the charts here in a few moments. Did want to let you know about some of the conversations we're going to have next week. As a reminder, Monday's the market holiday for MLK Day. So we'll be taking the day off along with hopefully most of you. We'll be back live Tuesday. We have 3 good guests for you. Bob Lank from Explosive Options will be coming through on Tuesday the 17th. On Wednesday, Dana Lyons, who's a portfolio manager at J. Lyons Fund Management. On Thursday the 19th, Tom Boley, who's a co-founder of Earnings Beats. Tom was part of our Market Outlook 2023 panel called Charting Forward. We just aired that earlier today. You can find the replay at stockchartstv.com if you missed it. So when we wrap the week, what we like to do is just focus on what we've learned over the last 5 trading days and really thinking about what's changed from last Friday to this Friday. So what we'll do is we'll take a look at some of the weekly returns and look at some of the details about what happened. But first, I do want to start with a poll. We asked you recently on our live stream page at stockcharts.com, also on our social media accounts. So make sure you subscribe to us on YouTube and make sure you follow us on Twitter at FinalBarSCTV. We asked you, which sector do you think performs better over the next 3 months? Consumer discretionary or consumer staples? Things you want or things you need? Offense or defense? And I love that question. This is a question I think about honestly every week as I'm getting my weekly report ready for my premium subscribers. I often think about this question. One of the charts we look at, which is part of my Mindful Investor Live chart list, is this one looking at offense versus defense. Because the idea is you're looking at trends, not just trends in the major averages, but actually trends in the buying and selling patterns on the stocks and sectors that comprise those indexes. This chart is one that I've argued with Tom Boley in a very positive, healthy way many times over the last 12 months. This is looking at this ratio, and in the top is the cap-weighted version, which I asked in the survey question, XLY versus XLP. And if you missed it, 58% of you said defense versus offense. Only 42% of you said the XLY. Now, what's interesting about this ratio is the ratio has been going down. In August, the cap-weighted ratio broke out, and that was really driven by the strength in Amazon and Tesla and Home Depot, which are the biggest weights in the XLY. But the equal-weighted version actually had not broken out yet. Then November, December, the cap-weighted ratio makes a new 52-week low, even though the equal-weighted version does not. Finally, here we get a rally in stocks, and the equal-weighted ratio is now finally breaking out. Now, why do I highlight all these different things? This bottom panel is the one that I pay way more attention to, and I'll tell you why. I think when you're thinking of cap-weighted returns, the S&P, the NASDAQ are already very weighted to the XLY. It's very weighted to consumer discretionary. So the equal-weighted version of this ratio, I think, shows you a little bit something different. You can see the distribution in the first half of 2022, the consolidation in the second half of 2022. As of today, literally Friday's close, we have broken out of this ratio to the upside. I think it was yesterday when it really powered through to the upside. But for the first time in many, many moons, we're actually making a new 6-month high. You have to go back to 2021 to see the last time that happened. That's actually a big check in the plus column, the way I would think about markets and think about potential trends. Let's continue on wrapping the week, looking at the returns today. We'll do is just look at what happened today. We'll connect it to the last 4 trading days and look at the week as a whole, and then we'll get through some of the broader measures of price, breadth, and sentiment. The S&P up 0.4%. Closing literally a rounding error below 4,000. How many times have we talked about that 4,000 level? And psychologically, right? You change that first digit in the S&P, that does not happen very often. So going from a 3 handle to a 4 handle is pretty meaningful. And so I think that level, the fact that we closed just right at 4,000, tipped above it, but didn't quite get there, might be important going into next week. That is 100% one of the levels I will be watching to see if the S&P can power above there. NASDAQ outperforming up about 0.7%. The VIX continuing to pull back below 20, below 19, now down below 1830. Bond markets overall coming off, and you see interest rates pushing back to the upside, but not by a ton. So bond prices came down. 10-year yields back above 3.5% at the close, and the dollar index pretty similar to where we started at Thursday's close. Nice continuation on the upswing for gold and silver charts. We talked about the GLD, and I think one of the surprises, if I had one from yesterday's market outlook, we ran it today, but recorded it yesterday afternoon, had a really fun discussion with those 3 experts. And we talked a lot more about commodities than I anticipated. And it was really, really interesting just to think about energy and oil prices and gold and precious metals versus risk assets and which would perform better in different scenarios, thinking about interest rates, thinking about the Fed, thinking about inflation. Really, really helpful conversation. But overall, I would say the 2 out of the 3 experts were certainly pretty excited about the chart of gold. I would put myself probably in that bucket as well, because you're seeing a lot of movement to the upside in an asset class that has been struggling to outperform in a long, long time. Cryptocurrencies, it's been a long time since I've been able to say this. Cryptocurrencies are breaking out. How about that? You see Bitcoin getting nearer and nearer the 20,000 level. We've talked about Bitcoin at 18,000 being important. Over the last couple of days, we've actually rotated above 18K and now powered above 19, getting closer and closer to 20,000, if not higher. We'll look at those in a minute. Just to wrap up today's information, top performing sectors, consumer discretionary up 1%. Financials up 0.7%. That's actually pretty interesting because you had a lot of banks reporting earnings before the open today at JP Morgan, Bank of America, Citigroup, Wells Fargo, a bunch of other financial firms. A lot of those opened lower, gap down at the open, but actually closed higher, which is an interesting way to illustrate the momentum coming in during the trading day. Let's look at what I call the wrap the week chart. This is just looking at the last 5 trading days. So we start the clock last Friday's close, January 6th. We're now looking at today's close. Where did we get to? So major, pretty good, solid up week for most of these things. You can see only one thing was down on the week, which was the dollar. The UUP, which is a bullish dollar ETF, finished the week down 1.5%. Everything else was positive. Underperforming the S&P, we have bond prices here, which are up about 1.5%. That's using the TLT, which is a sort of a treasury bond, long treasury bond ETF. So still up 1.5%. That wasn't enough to beat the S&P, which finished the week higher by 2.7%. Strong week. Now, everything else I'm about to tell you did even better than the S&P. So when you think about risk on markets doing well, I just own a passive product like the S&P. You're missing some potential upside by owning things that are outperforming. Here are all the things that outperformed the S&P this week. Gold up 2.9%, emerging markets up 3.1%. The NASDAQ 100 up 4.5%. This in purple is small caps. The Russell 2000 up 5.3%. Crude oil prices, after really struggling to participate, the USO is actually up 8% from last Friday's close. Bitcoin, the big winner, up almost 15% for the week. So when I talk about this nice rally in cryptocurrencies, I'm not making that up. It was actually a pretty good acceleration. And this is an asset class or an area of the market certainly that has been underwater for quite some time. And Bitcoin, even though it's tried to move higher, hasn't really materialized those gains. I think you're seeing a bit of a reversal to the upside with that here recently. We'll look at a couple different things. We'll start with the Mindful Investor Live ChartList, and I just want to highlight the fact I didn't change these labels yet. Our short-term model actually turned bullish last Friday, the first Friday in 2023. This week continuing to push higher. Obviously a nice week for stocks closing at the highs of the day, and that's a pretty nice move to the upside. The medium-term model actually went back positive, went bearish for 2 weeks, and now right back to the bullish side. So getting a buy signal from the medium-term model here as of today's close. My long-term model remains bearish. And so again, looking at the chart, short-term model recognizing the strength off of the December low, medium-term model basically capturing this move off of the October low, the long-term model still recognizing that even though we've rallied, we really haven't changed the trend yet, using that much larger time frame. So long-term bearish, medium-term, and short-term bullish, which is exactly how this market looks and feels to me at this moment. Now, a trend line we drew, and I was joking with Jeff Hirsch earlier this week, had a really good conversation with him on Wednesday's show. If you missed it, I would encourage you to check that out. We talked about the seasonal tendencies, and one of the most important charts that I think he shared with us was showing the seasonal strength from the fourth quarter of the midterm election year, which was last year, to the middle of the pre-election year, which is 2023, stocks actually tend to do really, really well in modern history. And so the fact that we've rallied off of the October lows is almost following the script perfectly. So it's important to know that that's showing great tailwinds to the major averages going forward, or certainly to stock prices. Now, what we've not seen is enough of a follow-through to break through some clearly established resistance levels. The S&P did manage to close above its 200-day moving average today. That's only the second time in the last, 9 months that we can say that. Most of the time has been spent below the 200-day. That's an important level, not just because it's a big red line on your chart, but also because I would tell you, working with a lot of institutional investors, even those that are not technically driven, right, that are not big chart people, they still look at a chart occasionally, and they certainly know where the 200-day moving average is. Every trading desk I've ever been on, they will know where the 200-day is for the major things that they're trading, because it's pounded into our heads as technically oriented market participants. So the fact that we get above the 200-day, if we can follow through next week, I think that is incredibly important. More important to me is this trend line, this green trend line. I was joking with Jeff Hirsch about the thickness of this line. I feel like I'm going to make it more and more thick to drive home how incredibly important this one is. But connecting the major highs in 2022 lines up pretty well with just above where we're at today. So right around 4,000 as we begin next week. Can we close above there next Friday? I think that would be a key question. Now, next week, a shortened week because of the Monday trading holiday, but certainly when we come back on Tuesday, we'll be following the price action relative to that trend line analysis. Now, I think the more conservative play would be wait until we get above 4,100. Does the RSI get above 60? We just got above there on today's close. So I think still some open questions, but we are right at that decision point. We talked about that in August when we approached these levels. We talked about that in November and December. Both of those previous times, the follow-through failed to materialize and we pulled back lower. Is this time different? We'll find out, I think, next week. Just to finish off this little segment here before we take a break, I just wanted to bring up the chart of Bitcoin because I've talked about it a couple times, and I'm a chart person, and I know many of you are as well. This is why 18,000 was such an important level, right? Big round numbers have tended to be pretty meaningful, and I have these horizontal lines indicating the big 10,000 level. So 20,000, pretty important one. Bitcoin is actually testing its 200-day moving average today. It has been below its 200-day moving average since late 2021, I want to say, maybe very early 2022, off the left side of the viewable area of this chart. But look what's happened in the last week. The RSI has powered above 60, which it's not done since the first quarter of last year. We broke to a new swing high, which has actually been incredibly rare. We're pushing above moving average resistance, and the RSI is getting above 60. All these things have happened, reinforcing to me that this is potentially a new bull move in Bitcoin. Now, full disclosure, I own Bitcoin and Ethereum and long-term retirement accounts in my personal accounts, but I like the strength that I'm seeing. For me, as a timing exercise, we just haven't seen the right timing, right? We haven't seen a higher low and then a higher swing high. I think after this week, we can say that that's the case. Let's take a quick commercial break. We'll be back continuing our discussion with the Power Up segment. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is a pleasure to put this show on for you. We have a really good team helping us to do so, and we have fantastic plans for this show in the coming weeks and months. We are fine-tuning our studio, which is kind of right behind me, behind that wall you see behind me on the camera. We're going to be getting in there very, very soon. We're excited to unveil some new features and capabilities with the final bar. A lot of great discussions, certainly with some of our guests as well. Did want to let you know about some of the couple quick announcements before we continue our show. First off, we welcome your questions. We're going to do a mailbag segment later in today's show. We'll do a couple more next week. And those questions all come from people like you sending in questions that come up as you are analyzing the markets. Email's the best way. That's thefinalbar@stockcharts.com. Twitter's good too. It's @finalbarsctv. And subscribe to our YouTube channel. Put a comment below the video you're watching there. We'll get those questions and hope to answer yours live on the air next week. Also go to StockChartsTV.com. Our most recent market outlook just aired today is available for your viewing pleasure on our on-demand platform. Also market outlooks from Martin Pring, from Larry Williams. A lot of our Stock Charts contributors did some really cool programming at the beginning of the year to give you some ideas and some perspective to get you started off right. Go to StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Our next segment is called Power Up. Our development team is working hard to upgrade the Stock Charts platform. We want to share with you some of those newer features and make sure you know how to use the best parts of our platform. Now, if you missed any of these, or if you missed any of our great releases last year, or if you're looking for some of the newer stuff coming out through the course of 2023, go to stockcharts.com/new. And we will always post some information. Our Camino release was just in mid-December, and all of these, by the way, are named after geographical locations in Washington State. So we had Alki after Alki Beach, Bainbridge after Bainbridge Island. We have Camino. D is going to be Deception Pass, if I remember right. But you'll be getting more information about that soon, and you can see all the different information about what is included in those releases. What I want to share with you today is the fact that we now have options data on the Stock Charts platform. Now, before you get too excited and start sending me all the things you think we should do, feel free to do that. But I'll tell you, this is just a start. We know we're not done yet. This is the beginning. Getting options data, talking to some of our options contributors, our guests, some of our strategic partners in the options market, and thinking about how we can best empower you guys to use options in your trading strategy and incorporate it really into the charting capabilities that we have. The start was, let's get the data on the platform. Let's show you for a stock or an ETF where the options are. So if you bring up a symbol, we have a new view called the options summary page, and I'm showing you this. This is for Apple, which has a lot of options on there. This is using what we call our straddle view, which is highlighting by strike in going from a low strike to high strike. So the strike price is basically the price, the underlying price that is assigned to that option. You can see the green shaded contracts are in the money. So we have calls on the left half, puts on the right half. You can see the strike prices, you can see the price, the volume interest, the volatility, and you can start to look at some of these different measures. This is the beginning, and from here, what we're going to be doing is adding some options analytics, give you the ability to trade more easily through in the options market through our platform. This is a starting point, but make sure you check it out. If you're looking for options pricing data, it is there. We have some really good discussions in the coming weeks and months to upgrade our options analytics. And as I mentioned, this is just the beginning. Let's continue on our next segment with the Final Bar Mailbag. As a reminder, the mailbag's always open, the Final Bar at StockCharts.com. These are all questions we've gotten from you basically this week. So let's get to question number one. Dave, why do the RRG table and the ChartList performance table show different results? And you sent a big question with some really good examples. I appreciate you sending that. I took some of the questions and some of the charts that you sent me, and I sort of converted into this one. So this is the ChartList kind of that you were showing me, which is the performance tab. As a reminder, if you bring up any chart list and you're looking at something like this, which is called our summary view, if you click to what's called performance view, you can actually look at a performance table. So you can quickly sort any of these columns. It is a fantastic way to analyze performance trends on different timeframes for any group of stocks or ETFs or indexes or whatever you want to put into your chart list. But it's a really fantastic tool. We added that earlier in the year, last year, and I've enjoyed very much using it as I'm trying to make sense of what's happening in the markets. Now, you're comparing what you're seeing here, like on the 5-day performance, with what you're seeing on the RRG. So the RRG below the relative rotation graph has this kind of simple summary of the different components on here. So I have these same 11 S&P sectors and then the S&P as well. And then I have this change here. So here's what I would tell you. The change here is driven by the tail length. So however long you make the tail. So if I say 0 weeks, it's saying there's no percent change. If I say 1 week, I'm going to get the 1 week percent change for each of these. And I would hope, Dave, that this lines up pretty well. Let's see what happens. Might just need to refresh the chart here. There we go. We're doing 1 week. I would imagine this is pretty close here. And it might just, yeah, so 5.8% for the consumer discretionary, technology up 4.6, real estate up 4.4. This looks pretty good. Now, so it is drawing from the same database. Now, what you had asked me was, I'm looking at 4 weeks, and then I'm comparing it to the 1 month performance. And these numbers do not match up. So communication services up 9%. Here it's showing consumer communication services is up 3.5%. Energy is up 5.1%. What gives there? Which you have to remember, you're actually looking at two different things. This is literally looking at the last 4 weeks. So it's last 4 Friday closes and comparing them to today. Here, we're literally looking at 1 month. So this is looking at January 13th versus December 13th. Now, if you go back and you think about what happened in mid-December, December 13th, 14th, 15th, 16th, which would get us probably to that Friday, was a big sell-off. So if you start the clock 4 weeks ago, versus 1 month ago, the returns are going to look very different because the price actually changed very quickly in December. So the short answer is you're looking at a little bit apples and oranges in terms of the timeframes, but the data does come from the same place, and we checked and rechecked, and it's in good shape here. So make sure you're matching the tail length and the periodicity, weekly and 4 weeks, with what you'll be doing here. You can't do like a 4-week return. That's not one of the options. 1 month is going to be close, but not the same because we're looking at different starting dates. And that's the reason why the numbers don't match up exactly sometimes. Question number 2, how do you reverse the order of the VIX values in the chart of inverse VIX above SPX? And you, let's see, you sent this in, I'm trying to remember when you'd sent this after one of the shows. I think it's when I showed one of these inverted ones as one of my 3 and 3, which I don't have, but I'll show you this one, which is similar. The chart that I use on my Mindful Investor Live chart list that looks at high yield spreads, I actually invert a couple of these series. So this is high yield spreads plotted upside down. This is the VIX plotted upside down, then the S&P plotted right side up. The trick is to use the minus sign, right? So if you put the minus sign before any ticker, it'll just invert the scale. It is a quick and easy trick. It's not super complicated, and I found it to be incredibly valuable, particularly when you have two things that tend to have an inverse relationship. Just plot one of them inversely, and you can now compare them much more easily. So this is meant to show that high yield spreads tend to tighten, meaning the numbers are going down. The volatility tends to decrease, meaning the numbers are going down when stocks tend to rise. And I like to line them up with the S&P at the bottom. To get one of these other panels to plot inversely, just put the indicator as price and the parameters minus sign, then the ticker. Easy way to do it. Next question. Jesse Felder showed a chart called COPP, C-O-P-P, with some parameters in there, and the SPX with bull market above and bear market below. What is COPP? What is that indicator? So I actually went back. I had saved on my laptop the chart that Jesse Felder shared. Jesse's fantastic, really thoughtful analyst, always brings some good long-term charts, and he was highlighting COPP, which is actually the Coppock Curve, or the Coppock indicator. This was his monthly chart that we showed on the air, and this is the Coppock Curve up here at the top. So I'll show you how you actually create this. We'll see. I think one of the rules is never test yourself on your ability to create something live on the air, but we're doing it. So first, I'm basically going to bring up a really basic chart. I'm going to make it a monthly chart, and I'm going to go back, we'll say like 20 years as a starting point. There we go. Now we need to add an indicator at the bottom. There's an indicator called COPP, and when you pop it up, it'll come up with these parameters, 14, 11, and 10. Here's the story of the Coppock Curve, and it's actually kind of a goofy, funny story. The origin of some of these indicators is actually pretty entertaining. Serge Coppock was a market strategist in the 1950s and 60s, if I remember. I think it was in the mid-60s. He actually published analysis and wrote an article in Barron's where he talked about this Coppock Curve. And literally what he did was he talked to an Episcopal priest about how long it takes people to mourn a loved one once they pass, right? Once they leave the earth. Well, how long does it take people to get over it? And the answer that the priest supposedly shared with them was about 11 to 14 months. So Coppock used that as the foundation of this indicator, thinking of when the market is in a bear market, how long would it take for the market to get over that loss? And so he went on the spread between an 11 and 14 month moving averages. So what you're doing is actually taking the 11 and 14 months, and then the 10 is a 10 period smoothing. It's a weighted moving average, if I remember right. And if we add this indicator, you'll see the Coppock Curve at the bottom. Now, long story short, the way you want to look at the Coppock Curve, I'm going to bring it a little bit more so we can get back to the 2000 peak here. The Coppock curve it moves very rarely, right? So you use this literally once a month. At the monthly close, you see if the Coppock curve has changed. If we go below zero, that is a bearish phase. The most important signal once we're in a bear market phase is, do we get back above the zero line? So that happened here, third quarter of 2003 after the '02 low. Happened at the end of 2009 after the 2009 low, went negative in mid last year. It is not positive yet. So it does not call the bottom, and it's not intended to. It's meant to recognize and acknowledge when the market has really recovered. I remember looking at this indicator back in 2010, and one of my analysts on the technical team of Fidelity was like, Coppock curve just went positive. This is huge. It happened in '03, and we went through it and looked at some of the previous recovery periods. And so I think as we would continue to rotate higher, if that's what we see through the course of 2023, keep an eye on this one. Again, up once a month is when you can really update this chart, but keep an eye and see if it doesn't. As Jesse Felder appropriately put on there, below zero is bearish, above zero is bullish. We're nowhere near that, and that would signal more of a broad rotation to another cyclical, secular bull market phase. We're out of time. We need to wrap the show. Really good questions, and thanks for making me think a little bit about some of these questions. It's really, really helpful. We need to wrap the show and go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Now, this is a chart that I just call the chart. It basically combines 5 key indicators, focusing on some of the key pieces of information. I was on a panel or at an event earlier this year called Market Vision 2023 that Tom Bowley put on. And this was the chart that I shared and basically talked through the components and why I think they were meaningful. Look at how this chart has basically rotated to more of a sign of broad bullishness. The second panel down, we'll come down to the price in a second. The advanced decline line in the New York Stock Exchange has now broken above its December high. I think that's a thumbs up bullish. More than 50% of the S&P 500 members are above their 50-day moving average. It's up above 75%, which is pretty strong. That tells you overall conditions are healthy. The bullish percent index on the S&P 500 is above 50%. It's up above 60. Now, it's not to the super bullish sign, which would be over 70, but overall pretty constructive. It's certainly not negative. The equal weighted consumer discretionary versus consumer staples ratio has not made a new swing high since the fourth quarter of 2021. As of today, I will tell you it has, or at the very least, it's really close to doing it. It's right there. This breaking out to the upside, I think, would be a fantastic validation of a risk-on environment. We've seen that looking at a lot of the individual names we've been talking about on the show. We've not quite seen it on some ratios like this offense to defense ratio. I think it's pretty much signaling it here on Friday's close. Now that gets us back to the price. On a closing basis, look at how well these closing peaks line up. I mean, just almost perfectly. Like if you drew a line ahead of time and projected where the S&P would top, it followed it incredibly well. We're now right up to that trend line yet again. We're testing that 4,000 level. Today literally closed right below it. Going into next week, my number one question for the markets, can we get above that trend line? Now, how do we do it? I would say earnings today were a big, maybe beginning of that thought process, right? You had banks reporting earnings, could have been a big catalyst to the downside. And at the open, it looked like those stocks were all stalling out and gapping lower on the news, but most of them finished strong, which shows you that there's additional demand and additional need for risk or desire for risk coming from equity investors. Is that enough to push us above these trend lines we've been talking about for so long? That's my number one question for next week. Finally, second, actually, we have the chart of Tesla. When I'm looking at Tesla, we have a what's called accelerated trend lines. This is where you have a downtrend line like you have here from November 21, January 22, April 22. You can see this trend line, but all of a sudden the price gets really far away from that. So all of a sudden you draw another trend line with an increased slope, like a steeper trend line to connect the April peak to the September peak. Now we're way far away. So you draw a third one. You rarely have to draw more than 3 accelerated trend lines. And this is usually the last one, which means we have an interesting way to confirm that Tesla has rotated to the upside. Is there enough to get above 135, 140 and get above that trend line? That would certainly turn me much more constructive on a chart that has just been a challenging chart from a technical perspective. Finally, the financial sector. Look at the XLF, how it opened lower and closed higher, just on a short-term basis. That shows you the additional demand, shows the additional risk appetite that we saw in the financial sector. Saw it in other sectors as well, but financials are key. This is the beginning of the new earnings season. Is this a sign that the rest of earnings season is going to continue to be constructive? That's a question for the next couple weeks. Folks, that's a wrap for the show. I want to thank you so much for joining us this week. All of our great conversations with Tony Dwyer, Jeff Hirsch, Ms. Schneider are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend. See you on Tuesday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.